Well, it is noon, and I know that everyone is busy, and so we're going to go ahead and get started. Good afternoon. I'd like to welcome you here today on behalf of the Nebraska Grazing Lands Coalition. We're so excited that you have taken time out of your day to join us for this webinar. My name is Angela Redmond, and I am with the Nebraska Grazing Coalition. For those of you who may not be familiar with our organization, we are a nonprofit, producer-led organization dedicated to the stewardship and sustainability of the Nebraska grazing lands. We work to support ranchers, farmers, and land managers through educational events, voluntary technical assistance, and partnerships that strengthen both the land and the families who depend on it. Today's topic is especially important as across the United States, it is estimated that roughly 70% of farm and ranch land will change hand in the next 20 years. At the same time, the average age of producers is on the rise, with many nearing retirement age. Despite this, a significant number of operations do not have a formal succession plan in place. Without thoughtful planning, families can face uncertainty, financial strain, and even the loss or fragmentation of the land that they have worked many generations to build. So that is why today's conversation is very important. Planning ahead isn't just about the finances or legal documents, it's about protecting the legacy that you've built, supporting the next generation, and ensuring the long-term viability of your operation. We are pleased today to have two knowledgeable speakers joining us. Jane Langen-Mock with Rembolt Ludke Law has been practicing law for many years. Her work has been focused on family law issues, particularly complex divorce, paternity, custody, and child support. Today, Jane will discuss premarital agreements and key legal considerations that can play a role in protecting your operation. She will also cover simple steps that you can take each month to protect your assets. Following her presentation, Miles Garwood, financial advisor with LPL Financial, will share insights on strategic financial planning for the next generation and share tips on how you can financially plan for yourself as you set the next generation up for success. Miles is a rodeo cowboy that grew up on his family ranch in the Sandhills and fell in love with financial planning in college. After obtaining an internship at Waddell and Reed, he turned his passion into a business of providing individuals and businesses with investment, insurance, financial, and estate planning advice. We hope that you all can find the information today valuable and are able to take pieces that you hear and apply it to your own operations. If questions come up as the presenters are presenting, feel free to share your questions in the chat box. Otherwise, we'll have a live Q&A at the end. And if you want to remain anonymous, you can also send Michelle Michelson, our office manager, a private message here in Zoom, and she will pose your question for you. Funding for these events are made possible through grants that we've received. This one was from the National Fish and Wildlife Foundation. You will have the opportunity to complete a short survey at the end, which we would appreciate you taking time to do, as that's how we maintain our funding for events like this. So thank you again for everyone being here today and for your commitment to the future of your operations. We'll go ahead and start with Jane. Thank you.
Well, good afternoon. Thank you everyone for being here. That was a great introduction. I want to tell you a little bit more about myself and my farm background. I grew up between Lincoln and Wahoo, Nebraska. My address was Wahoo, Nebraska. I grew up on a farm, and my family all has farms south of Kearney, so in central Nebraska. And so when my father passed away, I became also a farmer. I have a tenant. I don't actually actively farm it myself, but in the divorce world and in the family law world where I operate, there are a number of issues that relate specifically to farming and farming operations, and it is the biggest business we have. So having that personal experience has really helped me understand what owners and producers face as they go through some of these family law issues. People don't really want to talk about divorce, and that's great. I hope none of you are in the need to be talking about divorce, but my focus is on premarital agreements, and for that to be meaningful, I have to talk a little bit about divorce. The purpose of a premarital agreement is for people who are entering into a marriage to set their own rules. Sometimes people don't really like the idea of a premarital agreement. It feels off-putting to them. Uh, some people are offended when someone will suggest a premarital agreement. And my advice to those people is if you end up in a divorce, there will be rules. The question is, do you want the state to set those rules for you, or do you want to set them for yourselves? And I think a lot of people, when they look at it in that light, are much more open to trying to determine their own rules for how things are going to work. I think a lot of people assume that a premarital agreement requires that everything be kept separate. People might feel like it's not really a marriage. And that's certainly not the case. When you enter into a premarital agreement, you are determining in advance how certain assets, debts, and support obligations will be treated in the event there is a divorce or a legal separation or an annulment. But those rules don't have to be as harsh as everyone assumes. Sometimes they are. But a premarital agreement allows people to determine what will happen to their property and debt, whether separate or acquired during the marriage, in a variety of different ways. And so all kinds of options that are open. So what I hope that some of you will take away today is, again, hopefully none of you are in a spot where you're thinking about divorce or in that process or have anyone in your family that is, although I can certainly help if that's the case. I want us to be thinking about, specifically as it relates to succession and farm and ranch planning, I want us to be thinking about premarital agreements as part of that planning as family members or others that you know might be uh, getting into a marriage relationship. I'm going to try to share my screen if I can remember how to do it. I think. Okay, is that working? Is
Yes, it is.
anyone seeing a screen? Okay. So I want to talk about farm asset protection made simple. Three real goals for what I'm going to talk about today. We want to understand farm asset protection. We want to establish and maintain the safety of your farm and ranch assets. And then we want to talk just a little bit about legal considerations and practical steps. And then, of course, because I'm from a law firm, they make me say, none of this should be construed as legal advice. This is general information. If you need specific legal advice, please contact us or your family attorney. So, understanding farm asset protection. Here's why it matters. You probably already know that it matters, but family law is a really different area than some, in that when you go through a family law dispute, it really does often end up including the entire family. It's not just the divorcing parties who are affected. It is the parents and the grandparents who built the farm or who bought the farm or who, generated the particular wealth that's being transferred. It's the kids and the grandkids who are planning on farming those times in their future. And so the tentacles of everyone who gets affected is much larger. Need to protect the long-term stability of your operation by making agreements and making smart decisions. Common risks, of course, divorce, debt, and unclear ownership. And I will say that both debt and unclear ownership are also problems in divorce. Proactive steps make a difference. You want to try to keep track, keep good records. And part of what I'll share today is an analysis and sort of a checklist of a plan that you can do to make sure that your records are in good order in case something occurs. What sometimes happens in a farming operation is that one spouse will be primarily what I will call the person in the field, the person who is maybe out there driving a combine or feeding cattle and that kind of thing, and the other spouse sometimes turns into the role of the bookkeeper. That can be problematic in a family law situation if the bookkeeper is the person that has all the financial information and yet is not the person in charge of the operation. The disconnect there can sometimes be problematic. You can also have circumstances where the person who has been the bookkeeper but is not the active farmer takes a bunch of documents when they leave the house and leave the marriage, and people don't have backup systems. And then you're arguing and trying to recreate sometimes entire years of financial information. So that can be difficult too. We want to be set up for success and have a practical plan. So, establishing and maintaining asset safety. If you have any kind of family law issue at all, and again, we're primarily talking about divorces and premarital agreements, you want to you want to talk to a family law attorney who has farm experience and who knows how these things operate. Every operation is going to be a little bit different. Every family situation is going to be different. People sometimes have trusts that have been in existence for decades. Sometimes people don't have money documents at all, and they don't even have written leases. They're just doing things with a handshake. That is part of the Nebraska way, is that we trust each other, which is great until something happens and you can't. So prior to even entering into a marriage relationship, that's the best opportunity people have to set up their planning in a way that will protect them the most. People should, as early as possible, discuss prenuptial agreements to clarify asset ownership. And that includes identifying what you already have, but also what you expect to have. With people who are young and entering into a marriage, they may not have much at that time, but they may have an expectancy that they're going to inherit something, be a trust beneficiary, that kind of thing. Um, and a premarital agreement can govern not just what happens with assets and debts, but it can also govern support obligations. The thing you cannot do in a premarital agreement is predetermine the rights of children, custody of children, how child support is calculated, and that sort of thing. So people can talk and should talk as soon as they decide that they're going to get married, they ought to start talking about what that means from a legal perspective. We'll talk a little bit more about how appreciation and income work. Those are particularly thorny issues in divorces and in farm divorces, especially. Want to establish your asset baselines. One of the other great things about doing a premarital agreement is even if you think sort of the regular state imposed rules are fine, it gives you an opportunity to list everything that you have, all the property that you owned prior to the marriage, all of the debt that you had prior to the marriage, so that later, if you're in a situation of having to separate those things, you've got a good foundation to work from to show that certain assets really did belong to you before the marriage. It's really good to get appraisals for land, certainly not suggesting that people do them routinely because they are expensive, but a premarital agreement is a really good time to get all of those assets valued as closely as you can. And then keep records. As I mentioned, a lot of times it falls on the non-farmer spouse to keep records, and that can be both good and bad, but it can also be dangerous. So you always want to at least have a set of backup records somewhere. Have something on paper, something electronic, or electronic in two different places, so that you can always have access to the information, even if something goes awry. And you want to set clear ownership structures. I think Miles is going to talk about this a little bit, but I do want to just quickly mention that it's really common in a farming operation to have lots of different moving parts, lots of different trusts or corporate entities. So, for example, a husband and wife might own land individually, or they might own land in a corporation, but then they would, or an LLC, but they may have a separate entity to own the machinery. And a lot of times that's for liability purposes. It's easier to insure them and to keep them separate. So let's say you have a grain truck that gets in a car accident. If there's insufficient insurance to cover that loss, then the plaintiff or the injured party is more limited in terms of what they can get and can't get at the land and so on. So you want to look at different kinds of entity structures, how those might work in different kinds of scenarios. The other thing that sometimes happens in a farm divorce is that people will have different participants in the different entities. So maybe it's, I own a piece of land with my dad, but I own the cattle with my brother. And my brother and I and my sister own this piece of machinery. Or I inherited these three pieces of machinery, but I have these three kept separate. So it can get very complicated, which is why records really help. Organize all your essential documents. Again, paper files are great, electronic files are great. Just make sure that you have everything that you can and keep track of things as they go. Sometimes people will have their origination loan documents, but then they don't really have a good update of how much they currently owe or what their payments are. You're going to want to update your asset values annually. So a lot of people have operating loans or other loans through Farm Credit, and they'll fill out those annual financial statements, which are great. Sometimes those are checked carefully, and sometimes they're very, very rounded numbers. As I said, you don't have to go appraise everything all the time, but to the extent you can, have those numbers be as accurate as possible so that later, if you're in a spot where you have to testify to something, You don't have a document sworn under oath to a government entity that doesn't match what you actually believe something is worth. That can be problematic. And as I said, back up your records regularly. Make sure you have more than one copy of things. I think that my screen just sort of went crazy there. So I'm going to go back. Legal considerations and practical steps. Um, Document your ownership history. So again, what did you own and when did you own it? If it changed, when did it change? What are the documents that relate to the changes? Same thing with tracking value changes. And you want to record your financial contributions. So again, say you had a piece of land prior to the marriage, and then you bought a piece of land during the marriage. Well, the piece of land that you had prior to the marriage, you might be able to say is a separate asset. But if you paid down debt with it, some of that during the marriage and some of it before, then you have to do an allocation. And so that can get mathematically complicated. It's not impossible to do, and it doesn't mean you've lost your right to have a claim to the separate nature of that property. But if marital funds were used to pay down debt, then at least some portion of that is going to be marital, unless you said otherwise in a premarital agreement. So monthly action plan overview, I have a handout that I sent that I think Angela will share with people. But build your asset file, create a binder and a digital folder. Try to keep records of what you have had prior to the marriage, what was gifted to you, what was inherited by you, and what you purchased. And again, those can be a mix of things. It can be, that I got this piece of land at a discount, and that discount was considered a gift to me, but I had to pay a certain amount. Keep all of those records the best you can. You're going to want to match loans to your assets and record the payment history. If you end up in a divorce situation, a lot of times your loans are cross-collateralized. And so you bought a piece of land, you borrowed money for that, but they also took a lien, or have a UCC filing against your other assets. If you end up in a divorce and you're talking about who's going to pay this loan or who's going to get that asset, you want to make sure that you're not in a situation where one party has the asset, but the other party is responsible for paying the debt against that asset. Sometimes it has to happen that way, but it's risky because what basically happens is, say it's my car. If I have a car and my future ex-spouse has to pay the debt against my car, all they have to do is not pay it, and they're going to come take my car. Log improvements. Really common for someone to have something and they make improvements. If you're talking about farm or ag land, it might be putting up a fence, might be tearing down an old building. You want to keep track of those things and how much they cost and what value it added. So a lot of times we're looking at assessor records, that this piece of land was assessed at X, and then we know a year that a certain improvement was made, and so after that it was Y. Those assessed values are generally not 100% of value, but they at least give us a baseline or a proportion by which that change in your property might have increased the value. Summarize your land and assets, highlight valuable equipment and livestock. A lot of times people will rely on depreciation schedules, and those don't always work because things get depreciated out, but they aren't really worth zero. They just don't show up on a list as having a value, but they're there somewhere and they have some value. And just keep your financial records as organized as you can. Key takeaways, you want to build strong foundations, stay organized year round, be ready to prove your ownership and any changes in ownership that you can. So that's the overview of divorces and premarital agreements. I know I only have a couple more minutes, so let me just mention this. If you are in a spot where either you're considering getting married, someone in your family is, or a family friend, it helps to understand what would happen if they don't have a premarital agreement. And again, it's complex, but one of the simplest ways to explain it in a way that makes sense to people who aren't really going through this is you might inherit a family farm. You might be gifted a family farm. You might have purchased a family farm. But the increase in value of that property during a period of marriage is presumed to be something that is marital and has to be shared. So if I inherited a farm that was worth $3,000 or $4,000 an acre when I got it, and it's worth $7,000 or $8,000 an acre now, there are ways around this. Again, it's complex, but the presumption is that if I'm the farmer, that increase in value was active appreciation and is therefore now something I have to pay my other spouse to keep. Doesn't necessarily mean they'll get the land. That could happen. But more often, it's now I have to pay them to keep something that I thought was mine. Premarital agreements can help protect against that. They can limit how much property gets shared. They can limit how much support a person could get. Or even if they aren't limiting those things, they can define those things. And again, most farmers and ranchers I know don't love the idea of the government making rules for them. So having an opportunity to make them yourself would almost always be the way to go. I'm at 12:20, which I think is when I was supposed to stop. If there are specific questions for me, that's great. Otherwise, I think we are going to take questions at the end.
I think we might just go ahead and hold all the questions for the
Okay,
end, if that's
great.
okay. And we'll
Of
just
course.
blow right into Miles. Michelle does have your documents that she'll put into the chat for everyone.
Thank
And
you.
yes, so thank you. We'll move into Miles's presentation.
All right. Now to see if I can get my video started here.
Yep, it is up.
All right, perfect. Well, thank you for the opportunity to visit today a little bit about ranch legacy and financial planning. Um, as Angela mentioned at the outset, I was born and raised on a ranch south of Atkinson, um, a family operation, multiple generations, and so it's been a firsthand experience to walk through the planning piece and see some of the pros and cons to that. Um, and then the majority of my client base that I work with are either business owners or farm and ranch families, and so it's something that we deal with fairly regularly. Um, One of the big things I just like to mention at the outset, whenever talking about planning and legacy planning, is that every situation is unique. I don't know how often I get asked the question, what do most people do? What do people do in my scenario? And it's like, every situation has its own nuances. And so they're just really, in my experience, isn't a cookie cutter approach. There isn't really, this is, what people do in your situation. And so I'm just going to today hopefully present some ideas that may be able to be useful, maybe be something that you can take and build upon. But please keep in mind that each situation is so unique, and so certainly rely upon your own advisors as well when determining what's best for your situation. Um, so, with a ranch, um, yeah, I feel like the assets of the ranch, the cattle, the equipment, the land, of course, significant value there. Um, but I also feel like in family ranch situations, there's a lot more value than just the financial value. Having grown up on a ranch, there's just, those experiences, those, relationships, those opportunities to be able to instill characteristics in the next generation that are really hard to be able to replicate anywhere else. Um, you know, and so I feel like that's something that, it is really important. And I also feel like that plays into doing a good job on the planning side, because sometimes I run into situations where folks put all the emphasis on the day-to-day operation and making sure that things are happening the way they should and efficiently, but the time never gets taken to plan for the next generation, plan for the financial stability of the operation. And so even though, things may be going great operationally, the operation may be at some risk. And so um, I think it's important to prioritize that. And obviously, those of you that are on this call are already doing that. Um, and because of how much time it takes, to run a farm or ranch operation, I think sometimes some of the different opportunities, some of the different tools that are out there, maybe just never really even become known because you're just so busy in the operation from a day-to-day standpoint. And so there are a lot of different retirement plan types and I just want to touch on a few of them today that can potentially help ease the time of transition for a family, when the older generation is transitioning out. Um, and especially right now, I feel like this is such a unique time in especially animal agriculture and the ranching business, with the amount of profitability that there is right now that we haven't seen a lot in the past. I think it creates some opportunities to be able to tax efficiently plan for the future, for times of transition that historically has been more challenging just because of cash flow challenges and profitability challenges. Um, and when making an effort to implement a plan, you know, the continuity, the viability, but also the visibility. One thing that I run into from time to time is, you know, the next generation is hesitant to come back to the ranch just because mom and dad don't really take the time or don't feel comfortable or just for whatever reason don't really lay out what the plan is moving forward. And so then it doesn't give the next generation a lot of confidence to come back to the operation and step away from opportunities that they may have off of the ranch. And so I think that's another really big incentive in my mind for folks to spend the time and make the effort to be able to put a plan in place is because it may be the difference between a son or daughter coming back to the ranch or not coming back to the ranch is having that certainty that mom and dad have went to the effort to make this plan, and so we know kind of what we're looking at when comparing our field of opportunities. Um, so I mentioned earlier that retirement plans can potentially help during times of transition when the older generation may be stepping out of the operation. And like I said, especially right now with where profitability is, folks are interested in finding tax deductions. And so uh, I just put up here a few options that we use quite a lot that allow for contributions on a pre-tax basis. And there's two main types of retirement plans that folks use. Defined contribution plans, and defined contribution plans allow for like the name says, a defined contribution. And you can do it, 1 year, and depending upon if you have employees or not, you may not necessarily have to continue to do it every year. It can just be a 1 year. We need a deduction, so we're going to put money into what's called a simplified employee pension IRA, where you can put up to 25% of net business income and take a deduction for it. And then those funds can grow in a retirement account until retirement time. And then at that time, when withdrawn, then tax would be due on whatever amount is withdrawn in that year. Same, a solo 401k is a 401k similar to what a large business may offer, allowing for pre-tax contributions. But we do a lot of these for folks who maybe they don't have any full-time employees and they're looking for a tax deduction this year. They don't necessarily want to commit to doing something every year, but they need a tax deduction in this year. And they they want to be able to contribute as much as they possibly can. The SEP IRA limits their contribution to 25% of the net business income, whereas with the 401k, you can do a salary deferral Right now, the normal contribution is 24,500 is what an individual can contribute under the age of 50. And then you can also do the employer contribution similar to the SEP IRA, not to exceed 72,000 in total for the year. Um, and and so it has the opportunity if your income is such that the 25% maybe doesn't allow you to contribute as much as what you want, you are able to contribute as an employee and as an employer with a solo 401k. So those are defined contribution plans. Then there are what are called defined benefit plans. And a defined benefit plan is similar to, say, what the state of Nebraska might offer a teacher or something of that sort, where a promised benefit is made for that employee. And and it's based upon the amount of earnings that that individual has and what your age is. And there's an actuarial calculation that's done to determine the amount of contribution that would be needed to be made into a plan to be able to provide that promised benefit, that defined benefit. And these are pretty neat because especially for some families who maybe haven't necessarily saved a whole lot for retirement or for that time of transition in the past, it allows for some pretty large contributions. I have north of 100,000 on the slide, but we have some situations like this year where because of where profitability was at in this year, we might put several 100,000 into one of these accounts and be able to take a deduction for it in that year. For folks who are very near retirement and have high incomes, they do require a person to commit to it. The IRS likes to see at least a 3-year commitment to a defined benefit cash balance plan. So there's a little bit more of a commitment with those, but the opportunity to be able to put a lot more money away and capture a deduction. One thing I'd just like to mention with all of these different plan types is, when looking at, tax planning, year-end tax planning, and so forth, and you're looking, well, we might have a piece of equipment that we need, and or do we look at possibly doing a retirement plan contribution, a tax-deductible retirement plan contribution? Um, the equipment, of course, is going to provide you with a business expense in that year that is going to be both tax deductible and be able to allow for the deduction prior to the calculation of FICA taxes. So you kind of get a dual benefit there, whereas with retirement contributions, those are post FICA, post Social Security and Medicare tax. So something to be aware of. But I just wanted to mention these plans, especially for folks right now where profitabilities are at, and maybe looking to try and set things up for the next generation coming back, and maybe mom and dad looking to step away from the operation. A couple of other things I just wanted to mention is some tools that are um, uh, I see used quite a bit. And I have rent here, and people say, well, why would you have that on your list of things to talk about? Just because, say, if mom and dad are wanting to step away from the operation, and some of the kids are coming back, um, and you're looking for tax efficient ways for them to be able to receive income. Maybe they haven't saved a whole lot into retirement accounts over the years, but if they receive rental income, it can be a real tax efficient form of income because it's not subjected to the FICA. Share arrangements, kind of have a personal story here. So when my grandparents were kind of setting up their retirement plan, um, my grandmother actually she raised sheep on the side, and then she would put her sheep money away into retirement accounts and into investments, which gave them some flexibility to be able to step away from the operation. But then my grandfather also put his cows out on shares, and put them out with folks, not with his kids, but outside the operation, and that allowed for room for the next generation to be able to step in. And of course, a person has to fully vet those folks in which you're going into these arrangements and make sure it's going to be a smart decision. But that's a tool that I think is a really useful tool. Um, I did just put on here conservation programs, of course, with like the grassland CRP program and some of those FSA programs, that can also help to allow for cash flow for the retiring generation. Installment sales, yeah, I see from time to time where maybe the cattle or maybe the equipment are sold to the next generation in an installment sale agreement to help mitigate the tax on those assets, depending if it's raised breeding livestock or purchased livestock. But the potential to do an installment sale can potentially help reduce the tax liability of selling those assets. I did put 1031 exchanges on here as well. Yeah, I know probably 1031 is something most folks have heard of. The opportunity to be able to do a like-kind exchange of the sale of a piece of property into another property and not have to realize the capital gain that a typical sale would trigger. The reason I mention this is say that the retiring generation is looking to buy a house in town or move to an acreage or something of that sort. Maybe it makes sense to look at selling one piece of ground, executing a 1031 exchange, and if it ends up being their primary residence, there's what's called a section 121, which allows for the potential to avoid, if they have to sell that primary residence down the road, the realization of the capital gains on the sale of a primary residence. So sometimes 1031ing appreciated property into a residence can be a useful tool in helping be able to facilitate the next generation coming back to the family ranch. And I mentioned I have residual soil fertility. It's something that's been a hot topic here recently. And that's where, say the next generation is potentially acquiring a piece of ground, or maybe has inherited some ground, and especially now with profitability levels being where they're at, looking for some tax deductions. And this is where you'd basically have a soil study done on that newly acquired property, and then it's benchmarked against some very long-term benchmarks, and then the excess soil fertility is allowed to be deducted. And most CPAs that I see are deducting that over maybe a 3-year period. And then it can certainly work as a nice offset to help mitigate some current year tax liability right now. One thing that I know is I mentioned, touched on briefly, is just making sure to have a plan in place that you can clearly communicate to the next generation. And just allowing for them to be able to clearly see what the plan is and have confidence in it. And so I just touch on that here, and just laying that out so that it's clearly defined. Did just want to touch on a few other tools here. Life insurance. Of course, a second to die policy is sometimes used to help in estate equalization situations where maybe one or of the kids is coming back to the ranch, but the others are not. And you're looking for a life insurance policy that would pay at mom and dad's passing, but not until the second one had passed. Typically, the premiums are a little bit cheaper with these types of plans just because they are allowing for the insurance of 2 lives instead of just one. And so that can help to mitigate some of the cost a little bit. Disability and long-term care, especially long-term care, has gotten so expensive here in the last few years that there are starting to be folks that are just saying, what, we're not going to even look at trying to insure that. We're going to self-insure that. We're going to look at other tools to potentially, try and mitigate that risk. Even some Medicaid planning where, maybe all of the assets go into an LLC and the kids own that from the, well in advance of mom and dad's potentially needing care. And, potentially utilize Medicaid. Liability protection. And this kind of ties back in. We visited a little bit about retirement accounts at the outset. A lot of retirement accounts provide for liability protection as part of the retirement account. But then also, I think it's really important, especially with the age and the time in which we're living. It's really important, I think, to make sure that you clearly understand your insurance and your liability protections through your insurance and potentially an umbrella policy, something of that nature as well. And then making sure that your plan has an emergency succession. Of course, it's good to plan for the long term, but what happens if things change very quickly? And I think I'm out of time, and that hopefully is helpful in just presenting some different ideas, some different strategies that you can potentially explore with your own advisors to see if they could potentially be a good fit for your operation.
Thank you, Miles. That was really good. So let's take a minute here. If anyone has any questions that they would like to pose, to come off mute and pose to one of our presenters, let's go ahead and maybe start there. And then I think we do have a couple of questions that have been put into the chat. So. Go ahead, Anne. I see you off mute.
Yes, yes. Could you talk a little more about defined benefit plans? How much paperwork is involved? How expensive is it to establish them? And just kind of list some pros and cons of defined benefit plans.
Sure. Yep. So they are certainly more involved to establish than what a defined contribution plan like a SEP or a solo 401k are. But of course, there's an old economist I like to read. Thomas Sowell's his name. He says, "There's no solutions in this world. There's only trade-offs." And the trade-off being that it does allow for you to be able to contribute much more to it, but it is more involved. Some of the steps involved with establishing a defined benefit plan is you have to establish a clearly defined adoption agreement. Basically, that's laying the rules of the road, the promises that you are making within your defined benefit plan. And a lot of times it may be to yourself, but it has to be clearly defined to meet that requirement. There's the process of doing the actuarial calculations that have to be done. So the actuarial firm is looking at who all is participating inside of this defined benefit cash balance plan. What are their ages? What are their incomes? What is the amount of promised retirement benefit that is being made through this plan to them? And then, what needs to be contributed to be able to meet that promise? So every year with a defined benefit cash balance plan, there is an actuarial calculation that's going into how much have you accumulated towards meeting that promise. And based upon that and where prevailing interest rates are, how much do you need to contribute going forward to be able to fulfill those promises? And so that's something that happens every year. And of course, with something like this, where it's requiring an actuarial calculation on an annual basis, the costs are certainly higher. Depending upon the number of participants, is going to impact the cost. But usually, when I'm visiting with folks about these sorts of plans, I usually encourage folks to budget $3,000 to $5,000 a year for actuarial costs for plan administration and things of that sort. But if a person's able to put $200,000 or $300,000 away into the plan in that year and take a deduction for it, it can certainly pay for itself very quickly. One thing too, and I didn't put a slide together on this, but it can, if you're really needing to capitalize on getting deductions, it can also be coupled with a solo 401k. So you're contributing to the solo 401k that just like a regular employee would. The limiting factor when you have a solo 401k and a defined benefit cash balance plan is you can only contribute up to 6% as an employer contribution to a solo 401k if you also have coupled it with a cash balance plan. So just something to be aware of there too. Any other questions on that, Ann?
I have a question about, so say you're getting some income off of your property, you're a tenant. I mean, it's your property, but you're leasing it. Can you put some of that money in? Because otherwise, we're paying taxes on it as income, but can you put some of that money into one of these retirement plans, even if you maybe already have retirement plans?
So unfortunately, when calculating the amount that you could potentially contribute to a retirement plan, it's all with those retirement plans that we're looking at, those employer-sponsored type retirement plans. You have to have earned income to be able to substantiate the contributions to those plans. And so rental income would not meet that requirement.
Is there a solution for that?
There is certainly visit with your own accountant and your own advisors, but I do have some folks where they may have royalty income, they may have a lot of rental income, they may have a whole bunch of different businesses going on, and they may establish a management company. And so they might establish like a Class C corporation that's their management company. And, if you're to go out and hire a farm manager, a ranch manager, they might take 10% of revenues or something of that sort to manage your assets for you. We have some folks that will set up an entity to do that, and they'll provide their own management services to all of their different operations that they may have going, and then pay themselves a wage out of their management company that provides them with the earned income because their other operations didn't have earned income, or their other interests didn't have earned income. And so then by having that earned income from their management company, it allows them to be able to contribute to some of these different plan types.
Anyone else have a question that they would like to ask Miles or Jane?
I've got one for you. One for each, actually. As far as Jane, I was wondering if you could maybe walk through just like a small example of what it might look like on the party side of things, and with that appreciation and the way that works. Just because I know that's getting to be a bigger deal all the time, and is
Yeah.
really impacting some farm and ranch families. So I wondered if maybe you could almost just like walk us through an example
Sure.
on how that might look.
So, thank you for that. So, Pardee is the name of the case the Nebraska Supreme Court decided a few years ago. If you go through a lawsuit, the name of the parties ends up being the name of the case. So, some people got divorced. Their name was Pardee, and they disputed a lot of things, but they had a bunch of farmland that ended up being part of the dispute. And the Nebraska Supreme Court in that case said that even if you had what was otherwise a separate asset, so let me back up one more step. In Nebraska, there's a presumption that whatever property you have at the time of the divorce is marital property and that you have to share it. The exceptions to that, the principal exceptions to that, are premarital property, so something you owned prior to the marriage, something that was gifted to you, or something that was inherited by you. Uh, and so what the court said in that case is even if the land was, in this case, husband, even if the land was husband's separate property, because some was premarital, some was gifted to him, and some was inherited by him, even if it was separate property, that the appreciation, the increase in the value of that land during the time of the marriage was presumed to be active appreciation. So I think I mentioned a little bit about this, but I'll spend a minute going into some more details. So basically, I think the example I gave was, you get farmland at 4,000 an acre, and when you go to get divorced, it's worth 8. That is what we call appreciation, just the increase in the value of the land. Lots and lots of reasons that land can appreciate, right? It depends on what other farmers have sold for in the neighborhood and who your neighbors are, and is it adjacent to somebody else's piece, and a whole lot of other things. But what our Supreme Court says is if you're a farmer working the land, we're going to presume that it increased in value because of your efforts and your work. That goes back to a case that was decided about 10 years ago that involved a construction company that had increased in value during the marriage. And in that case, that made a lot of sense, right? The guy is going to work every day and he's building the business and he's doing the things. And they say, okay, well, your business increased in value because of your work. That's active appreciation. That doesn't necessarily seem to apply the same way to a farm, uh, because, working a farm doesn't necessarily make the land worth more. Usually it's the scarcity of the land that makes it worth more. But in any event, Supreme Court said same rule applies. Maybe we won't count it as active appreciation if you can prove it's not, but the burden is on you to prove it's not. And I think most of us have probably heard that phrase. It's really hard to prove the negative. It's hard to prove that it increased in value and that it wasn't because of anything you did. The easy examples I gave of, tearing down a building or putting up a fence, those are kind of obvious. But what if you didn't do any of those things? You just farmed your land. Well, when the Nebraska Supreme Court was deciding the Pardee case, they looked at a case out of, I think, Tennessee, where the Tennessee Supreme Court said, yeah, just the act of driving a tractor across your land makes it worth more. And I don't know where that view came from, but that's what they said. So our courts are, they're kind of trying to stabilize this a little bit, but it's a really difficult situation. And what ends up, part of the reason that I'm a big proponent of premarital agreements is for this reason. And I have actually said to people, uh, what you don't want to have happen, one of the worst things that can happen is someone inherits or is gifted the farm. It's the family farm. It's been in the family for 100 years. And later they get divorced. And now they owe that person money, right? You say, well, the other spouse isn't going to get my farm. I just owe them some money. But what if the only way you can get enough money is to sell the farm? That's the risk that you take. And so that's part of the reason you want to have those preventative steps in. Did that answer your question, Weston?
Yeah, I did. Thank you very much
Okay,
for going
thank
through
you.
that example. Yeah, I just know it's getting to be a bigger deal all the time and can be like a multi-million-dollar deal for a lot of farms and ranches. So
You're right. Thank you.
yeah, thank you. Miles, I guess my question for you, I know you were talking just briefly about installment sales there a little bit as, a planning tool that can be used. You ever run into like depreciation recapture concerns, like especially like on the equipment side of things there?
Hmm. Yes, yep. And I that's kind of the reason I referenced too, as far as purchased versus raised, breeding livestock and so forth as well. So yeah, absolutely can be an issue and definitely something to visit with your accountant about if that installment sale agreement makes sense in your situation.
Thank you very much.
Thanks, Weston. Does anyone else have a question they would like to ask one of our presenters? We do have a couple of questions in the chat. I think you sort of touched on one of them just a little bit, so I'll ask the second part. What types of conservation, trusts, easements, and legacy planning vehicles should be considered that could both protect the land and continue benefiting the local community? Do you have a recommendation, Miles?
Yeah, that would be something I would probably encourage them to visit with their advisors on as far as what might make the most sense in that situation. The big thing, the reason I mentioned that is more from the planning side as far as, the cash flow perspective and being able to generate the income needed for, the, the execution of a transition plan.
Okay. And would you recommend using Social Security as an investment tool for an older farmer who doesn't have many investments?
So as far as Social Security goes, of course, that is something that can really be controlled quite a bit in a farm or ranch situation if you're filing a Schedule F as an individual. As far as how much you potentially report, what you do for tax planning from that perspective. Generally speaking, I think of Social Security as a horrible investment. And so if you can, yeah, so yeah, I usually, yeah, I don't encourage folks a lot of times to, try and keep their taxable income, the earned income high to be able to have a larger Social Security benefit. If there are other tools available to help mitigate that, just because right now, just as where the promised benefits are right now relative to what a person contributes, it's not a great investment. And I believe, the Congressional Budget Office has said in 2032, I believe it is, that the Social Security Trust Fund is set to be depleted. And so, there's some, I think, real concern as far as going forward, if the benefits are going to be what are promised right now. So I would say, make sure and try and have your financial plan, your retirement plan be hopefully stable without having to rely very much upon Social Security.
Good advice. Michelle, did you get any questions privately or see any more in the chat that I missed?
Nope, those are the only questions we had.
I do have one more that maybe you can touch on as my son is standing behind me here. Do you have a recommendation on paying farm and ranch kids as far as paying them a wage or investing it for a tax benefit for parents? So
I love that. Paying kids is such a cool tool. Uh, you know, Especially if it, with where we're at right now as far as profitability goes, like we've been talking, and then it opens up the opportunity for those kids, if they have earned income, to potentially even contribute to a Roth IRA. And I know I didn't touch on Roth IRAs today, focusing more on the pre-tax side. But a Roth IRA would be an after-tax contribution, allowing for tax-free growth. But cool thing, if a young person is able to contribute to a Roth IRA, which one of the prerequisites is they have to have earned income, and then are able to use that earned income to contribute to a Roth IRA, they can take money from a Roth IRA for a lot of different purposes, for college if need be, $10,000 for a first-time home purchase. One thing that some folks are unaware of with Roth IRAs is the opportunity to be able to take your original contributions or your basis out of a Roth IRA. So it can kind of be a multi-purpose account, even for those ranch kids that say, you know what, I don't know for sure yet what I want to do. Maybe I'm going to want to come back to the ranch. Maybe I'm going to want to use this money to buy bred heifers or something of that sort here in a few years. But I don't know for sure. You can still, use that account kind of as a tool to be able to meet those objectives as well. So I like it, the potential for mom and dad to be able to, take that deduction for those wages paid. But I really like the opportunities that it opens up for the kids and allowing them to be able to start saving into Roth IRAs.
perfect. Thank you for that. If anyone else has any questions, we'll give you just a few minutes to come off mute here. But otherwise, Michelle, if you want to put up our final slide where we have a QR code that you can scan with your phone, and it will send you directly to our survey that we would just greatly appreciate everyone taking time to fill out. We'll also be sending out an email with that if you don't have that capability. And we will attach Jane's information that she's sharing and some other articles that she shared with us that she has put together. And if Miles has any information he'd like to share, we'll attach all that in a follow-up email for everyone. So I don't see anyone else coming off mute. So
The survey is actually going to be put in the chat. That QR code will send people to our website for more.
okay. Okay, perfect. Sorry about that. All right, well, there is the survey in the chat. If you have a few minutes right now, we would greatly appreciate you filling that out, but otherwise we'll be sending it out. So thank you, Miles and Jane, for your time today. I really appreciate it. I hope that everyone has learned as much as I have.
Thank you.
Thank you, everyone.
Thank you.
Thank you.